The best way to make money is to solve a problem, says Robert Kiyosaki. But what if the problem you're trying to solve is how to make more money than your full-time job? Today, I'll reveal 3 distinct portfolio strategies, each built around 2 powerful ETFs that could be the solution you've been searching for. Let's cut to the chase. The average full-time job in the US pays about $66,600 to $22 a year. But what if I told you that with the right 2 ETFs, you could make more than that without working a single extra hour? Let's break it down. To replace a full-time job, you need a dual-engine strategy, growth and income. Here's why this combo is unstoppable. Growth ETFs exponentially compound your money. Think of it as planting a tree that grows taller each year. Income ETFs will transform that tree into a fruit factory and pay you cash monthly. By strategically blending these 2 forces, you can build a portfolio that pays you back every single month and eventually replaces your salary entirely. Now, in this video, I'll show you, first, the 4 golden rules for building a 2 ETF portfolio. Avoid critical mistakes most investors make. Next, portfolio strategies. I'll show you 3 different portfolios of 2 ETFs that maximize both growth and income. And I'll show you the exact math. Our $10,000 investment could grow into $4 million and generate $84,000 annually in dividends. Yes, that beats the average salary. Stick around. I'll even show you how to adjust these strategies if you're starting late. Before we dive into the specific ETFs, let's talk about the rules. Most investors fail because they skip these fundamentals. Follow these 4 golden rules, and you'll avoid the traps that ruin 90% of portfolios. Rule number 1 broad market ETF. Your first ETF should be a broad market fund. Think S&P 500 like VOO, total stock market like VTI, or global options like VT. These options provide instant diversification across hundreds of companies, and the mistake to avoid is don't try to outsmart the market by picking 3 or more sector ETFs. I've seen portfolios with a tech ETF, healthcare ETF, and real estate ETF that overlap with VOO. You're simply paying extra fees for redundancy. Pair VO with a non-overlapping ETF to diversify effectively. Rule number 2, your second ETF must match your goals. Your second ETF isn't about what's trending. It's about what you need. The mistake to avoid is copying someone else's portfolio just because it performed well last year. If you're 25 and copying a 60-year-old 7% dividend portfolio, you're leaving millions on the table. Ask yourself, do I need income now, or can I wait 10 plus years? Your answer will determine your second ETF. Rule number 3, allocate based on your risk. Tolerance, not on a guru's advice. Allocation is key. Adjust the percentages for each ETF according to your risk, tolerance, and investment duration. Younger investors prefer an aggressive approach, such as 80% in growth ETFs and 20% in income ETFs. As retirement approaches, or if you seek less volatility, gradually shift to a balanced 50-50 split to protect your gains while still earning income. The mistake to avoid is putting 50% into a leveraged NASDAQ ETF just because a YouTuber said so. You have to sleep at night when the market crashes by 30%. Use the sleep test. If your allocation keeps you awake, dial it back. Rule 4. Consistency beats timing. The biggest mistake is trying to time the market. I've seen investors sit on cash for years, waiting for a crash, only to miss out on 100% plus gains. Fix it by automating your buys, setting up weekly or monthly investments, and never stopping. Bull markets or bear markets, just keep going. Consistency is everything. One last thing, never break these rules. You'll be among the top 10% of investors if you follow them. Now, let's get into the exact ETFs I'd pair for life-changing returns. Let's start with rule number 1 of building a 2 ETF portfolio that is a solid broad market ETF. I'll break down the top options of broad market ETFs so you can choose the perfect foundation for your goals. First, let's compare the big 3, SPY, VOO, and IVV. All 3 track the 500 largest US companies, providing instant diversification and a history of around 10% annual returns. SPY, SPDR, S&P 500 ETF Trust, has an AUM of $633 billion, an expense ratio of 0.09%, and a dividend yield of 1.16%. It is best for traders needing liquidity. VOO Vanguard S&P 500 ETF, has assets totaling $631.78 billion, an expense ratio of 0.03%, the lowest, and a dividend yield of 1.20%. Its holdings include 507 stocks, making it slightly broader than SPY. It is best for buy-and-hold investors who prioritize low costs. iShares Core S&P 500 ETF has assets totaling $608.93 billion, an expense ratio of 0.03%, a dividend yield of 1.25%, and a one-year performance return of 22.17%, slightly outperforming SPY. It is ideal for those seeking the institutional strength of BlackRock. Key takeaway: VOO and IVV are nearly identical. Choose based on your brokerage preferences and save SPY for active trading. Next, these are broader market ETFs that go beyond the S&P 500. First is VTI, Vanguard Total Stock Market ETF, which tracks the CRSP US Total Market Index. It has an AUM of $481 billion and includes over 3,600 US stocks, large, mid, and small caps. The ETF has an expense ratio of 0.03% and a dividend yield of about 1.22%. Its growth matches the S&P 500 while also providing small cap upside. Next is the VT, Vanguard Total World Stock ETF, which tracks the FTSE Global All Cap Index. With an AUM of approximately $43 billion and holdings of over 9,800 global stocks, 60% US, 40% international, it has an expense ratio of 0.06% and a dividend yield of 1.85%. When it comes to diversification, it is a one-stop shop for global equity exposure. But it matters because VTI and VT are perfect. If you want to avoid companies based solely in the US, pair them with a dividend or sector ETF for balance. Now that you've chosen your broad market ETF, let's pair it perfectly. I'll break down 3 battle-tested portfolios. Whether you're seeking growth, dividends, or stability, these combinations are your ticket to financial freedom. Let's dive in. Portfolio 1, Total Market plus Dividend Growth, VTI plus SCHD. This pairing combines total US market exposure with dividend strength. It works well because VTI charges a 0.03% fee, delivering a total return of 21.59% over the past 12 months, covering over 3,500 stocks, and showing a 10-year compound annual growth rate of approximately 12.84%. SCHD, Dividend Aristocrats ETF, has a 0.06% fee, a one-year return of 8.81%, a 3.56% dividend yield, and a 6.80% annual dividend growth. Experts recommend allocating 60% to VTI and 40% to SCHD. Let's examine the pros and cons of investing in Portfolio 1. The pros include balanced growth, VTI's diversification, and SCHD's reliable income. Another advantage is tax efficiency. SCHD's qualified dividends result in lower taxes. The cons include slower growth. SCHD tends to lag behind VTI in bull markets. Let's see what happens if Eric invests $10,000 in a portfolio that allocates 60% to VTI and 40% to SCHD, allowing compounding to do its magic. In year 1, his portfolio grows to $11,277. By year 10, it reaches $35,049, tripling his initial investment. By year 20, his portfolio skyrockets to $183,745, and he realizes the true power of long-term investing. Finally, in year 30, Eric's portfolio surpassed $1.27 million, transforming his $10,000 into a fortune. Now Eric knows compounding is pure magic. Following Portfolio 2, Growth and Small Cap Value, VOO plus A, VUV. This duo combines the stability of the S&P 500 with the explosive potential of small cap value. It will work because VOO has a 0.03% fee, a total return of 22.24% over the past 12 months, with a 23.45% compound annual growth rate, and a 1.20% dividend yield. AVUV, US Small Cap Value ETF, has a 0.25% fee and 13.13% historical returns. The most impressive aspect is that there is zero overlap with VUO. Experts suggest allocating 70% to VUO and 30% to AVUV. Let's examine the pros and cons of investing in Portfolio 2. The pros include diversification, VOO's large caps, and AVUV's small cap value reduce correlation. Another pro is the growth boost, as small cap value stocks have historically outperformed over the long term. The cons include volatility, as AVUV is highly volatile. Let's see what happens if Eric invests $10,000 in a portfolio consisting of 70% VOO and 30% AVUV. In year 1, his portfolio grows to $12,035. By year 10, his investment skyrockets to $67,846, and he's thrilled by the rapid growth. In year 20, he's shocked to see his portfolio reach $857,621, nearly hitting $1 million. Finally, in year 30, Eric's portfolio explodes to $4,010,402.68, turning his $10,000 into over $4 million. After this period, Eric's annual dividend income from VOO will be around $46,328.21, providing a robust passive income stream. Finally, portfolio number 3, stability plus high yield, BND plus JEPI. This duo combines bonds for safety with covered calls for significant income. It works because BND, Total Bond Market ETF, has a 0.03% fee and a 3.68% dividend yield, while the 10-year total return for BND stock is 15.14%, experiencing less volatility than stocks. JEPI, JP Morgan Equity, Premium Income ETF, has a 0.35% fee and a 7.16% dividend yield and pays out monthly, with a 1-year return of 5.34%. Experts recommend an allocation of 50% BND and 50% JEPI. Let's examine the pros and cons of investing in Portfolio 3. The pros include steady income and low volatility, as bonds cushion JEPI's stock swing. The cons include limited growth, because bonds and covered calls lag in bull markets. Let's see what happens if Eric invests $10,000 into a 50% BND and 50% JEPI portfolio. In year 1, his portfolio grows to $10,719. By year 10, his investment reaches $22,607. Eric feels that while it's not skyrocketing, the reliability reassures him. In year 20, he's thrilled to see his portfolio grow to $72,894 as JEPI's reinvested dividends compound significantly. Finally, in year 30, Eric's investment stands at $197,409, nearly 20 times his initial amount. Thanks for watching. You've seen how a simple 2 ETF portfolio can boost your financial future. Now, imagine tapping into AI-driven growth. Our next video, Top 5 AI Stocks to Buy for Massive Growth in 2025, will show you how. Click the video on your screen to transform your portfolio.